A bounce yesterday evening off the back of a scheduled meeting for next week between Secretary Blinken and Minister Lavrov. That was building confidence just a little bit. Tom, then we've rolled over. Rolled over through the morning and now into negative territory. A headline from Interfax. According to Interfax, Donbass separatists say women, children will leave for Russia, Tom, evacuating women and children and taking them to Russia.
There's no question about it, and we've seen it. And John, just to go through it quickly or not to waste time from Kelsey Barrow, but Swissy shows it's stronger. Swiss and gold back above $1,900 announced. John, what do you see in the Bloomberg right now?
Yields in, Tom. A couple of basis points on 10s, back to 194.
We're going to continue with this and continue to monitor headlines as we see out of the various European sites. Kelsey Barrow has one of the toughest jobs on Wall Street. There's a guy named Michael she's got to report to, and he is tough as nails. And what that means is pro-acuity. We do not talk about overnight index swaps. That is massive, massive inside fixed income baseball. It's something you'd see in chapter 23 of Frank Fabozzi. Kelsey Barrow joins us now from JP Morgan Asset Management. And what you're focused on is not the spot overnight index swap, but out a couple years. Translate for mere mortals.
Yeah. Absolutely. So the OIS curve, what it shows us, the forward OIS curve is the path for the Fed funds rate, not just this year, but into 2023 and 2024. And one of the things that is really interesting about the curve right now is it's actually started to invert. So the market is pricing in rate cuts in 2024. And this is unusual because I mean, the economy is still extremely strong. 500,000 average job growth per month. Yet we're seeing these cuts. And the bottom line is this will continue until the market is proven wrong. They need to see the cut happen. They need to see the economy not break down as a result of higher rates. That's the only way you get that higher terminal rate that everyone's talking about.
So for you and me, our world stops Friday night at 7 p.m. That's okay. Hold on. I'll have another drink, but I've got to read JP Morgan Weekly Prospects right now. Ferroli and Company are going to publish tonight off the Fed Speak Today. Can the Fed Speak Today move your world?
No, I don't think the Fed Speak's going to move the world. This is what I noticed from the minutes, and I know you don't like to read the minutes, but let me just tell you about what was not said in the minutes, right?
Kelsey did a research, Tom. She did a research. Carry on.
It's not about what they said. It's actually the words they didn't say. So let me tell you.
Please, go.
The words they didn't say.
In front of Bruce Kasman now and talking 50 beeps for sure?
Yeah. If the market is allowing it, they're going to walk through that door.
Bob Michael's there. I caught up with Bob earlier this week, Kelsey. He wants to see 50. What he said, Kelsey, was interesting, and I know you two work really closely with each other. It's what happens if we don't get a 50 basis point hike. He actually thinks we get an adverse reaction because the market starts to believe they have not got control of this. What would you look for?
Right. So the market doesn't like to be surprised, and the Fed doesn't like to surprise the market. And so if the market is pricing in a high probability of 50 basis points, the Fed should take that opportunity, take it as a blessing, and go with it. I mean, I think the thing here is that they want the market to follow the data. And the data over the last couple of weeks, we got the CPI report, we got the payrolls report with the backward revisions for the full year. All we're seeing is that the economy is still red hot. And unless Powell comes out and walks this market back, if the market is pricing 50 basis points, the Fed should walk through that door.
Well, let's talk about credit strategy now. What is it, Kelsey?
So in credit, we're still seeing some opportunities, but we really do want to start focusing on getting higher in quality and focusing on structures that are shorter duration. So that's things like securitized credit, bank loans. And I'd also like to say, you know, we're looking at EM local this year, which is a really interesting one because you'd think with the central banks on the move, this would not be a good time for emerging market local debt. But actually, it's been one of the only areas of the fixed income market that has had positive returns. And my observation here is that EM central banks who were hiking like crazy in 2021 have actually had the foresight and the diligence that DM central banks didn't have, and were the ones that were hiking rates, now have the cushion and have been able to withstand more of this volatility this year with the DM central banks moving forward.
Kelsey, until a couple of weeks ago, the Fed has really dominated all headlines with respect to markets, and now we're being distracted or perhaps dominated by the Russia-Ukraine Russia-Ukraine conflict. There's been a huge divide into what the Fed response would be and what the market response would be should the escalation continue to get worse. What's your view in terms of, does it make it more likely for the Fed to go and hike more quickly or less?
Yeah. So in the very near term, we know that treasuries serve as a safe haven, a flight to quality. They go to the most liquid point on the curve, that 7 to 10-year point. That's what's going to rally when there's a lot of uncertainty. But when I look at the minutes, going back to those minutes, they mentioned geopolitical tensions a number of times, and they only mentioned it in the context of higher inflation, upside inflation risks. So I don't think that this conflict is going to stop the Fed from removing accommodation.
This is the key concern for a lot of people who are relying on the Fed as a put, and maybe not explicitly, and they realize that it's not going to be. But what is the implication for a market that could potentially be torpedoed by an economy that's slowing in the face of these higher oil prices, in the face of faster inflation, but with a Fed that does not respond?
The Fed is in a very challenging spot. I mean, we've been saying this for a while, and it really hasn't gotten any better. So I think the Fed is going to need to watch financial conditions closely. And, you know, at this point, financial conditions are still very easy. And so they watch that. I know they watch credit spreads. And at this point, although they are wider on the year, you know, there isn't an issue with companies being able to get the liquidity that they need.
John, the committee expects it will soon be appropriate to raise the target range. The committee decided to have lunch. Beginning in February, the committee will increase its holding. I'm reading the damn minutes.
Is that your version
John,
of the minutes?
This is more boring than I expected.
Kelsey came out with a call this year, Tom, before almost everybody else, which was the ECB will hike this year. Kelsey, you said it in early January, then all of a sudden, week after week after week, everybody started to join in. What changes for the Fed this time around when the ECB is set to get involved as well?
So sell-offs in U.S. Treasury yields are not generally sustainable unless they're global in nature. Because what happens, and we saw this in 2014 and 2015, for example, is that when the Fed tries to go on its own, the dollar strengthens, that tightens financial conditions, and the Fed ultimately has to back down. The fact that all the central banks are moving together is very, very powerful. So the ECB, sure, you know, they're still a long way behind the Fed. They want to see wage growth. They have to end QE before they focus on raising rates, but they're going to get there. And then I'll just say the next shoe to drop, and you know, this is still far out in the horizon, but these are the types of things that we're really thinking about further out in the future, is what happens with the BOJ and their yield curve target? What happens when Kuroda ends up moving out of the position and someone else comes in, and we start to see inflation move higher? Because right now inflation there, it's still negative, but there's a lot of distortions there. So we do actually think inflation is still low in Japan, but we could be getting closer to positive inflation fairly soon.
Kuroda's the last man standing. What would drag him away from all of this, Kelsey?
So not in the near term. He's going to stay put. We just saw that the Bank of Japan continued to defend their yield curve target. So they're not in any rush. Nothing is really putting the same pressure on them. You know, they still have negative inflation, whereas they don't need to deal with the headline of 7-8% inflation like the U.S. has. So they're not going to step away anytime soon. But when you think about what causes a more meaningful repricing and term premium across developed market nations, you have to think beyond the U.S., and you have to think about the BOJ, the ECB, and all of them moving together.
Kelsey, next time, 1 p.m. Fridays, we all read the minutes on Bloomberg Real Yield. You know that.
Some
Kelsey
of us
Barrow.
read them on Bloomberg Surveillance, too.
Two of
Just
us.
saying, two of us.
JP Morgan Asset Management. Kelsey, thank you very much. Some headlines from the president of Russia, Vladimir Putin, right now, Tom. He says that the drills in Belarus are defensive. They don't threaten anyone. He goes on to say Russia is not against talks on U.S. security proposals. The stance of the Russian president, Tom, right now.
It is, and Mr. Putin, with the headline moments ago, maybe the key one as I glance through them, there's a lot of headlines coming out. Kiev just needs to discuss conflict with separatists, and in the Minsk agreement, or I should say agreements plural, John, that's a key distinction here. Russia doesn't want to speak to Kiev. They want Kiev to speak to the separatists, which they believe are separate from Moscow.
It has been quite a ride over the last 12 hours or so. We got a lift to the equity market initially after a scheduled meeting for next week between Minister Lavrov and Secretary Blinken. Blinken. That takes place in Europe next week. Then we turned a little bit lower through the morning and then into negative territory of an Interfax report that those separatists that Vladimir Putin, the president of Russia, is talking about right now, are evacuating children, women, and the elderly back to Russia and away from the contact line. And Lisa, then these headlines from the Russian president just settling things down again. I mean, we are getting whipsawed from headline to headline. The degree of uncertainty out there right now is absolutely massive. And I think if you're in this equity market, Lisa, at the moment at least, it's just tremendously difficult.
It is tremendously difficult also, especially since oil doesn't seem to be responding. And that seems to be one of the triggers for economic fallout from this conflict. Seth Jones, though, I've got to keep going back to what he was saying. The troop buildup and some of the less traditional military forces, cyber warfare and other things, really does indicate the preparation of some sort of altercation that will happen. And that, to me, is what a lot of people are concerned about right now.
That was his interpretation of the incoming headlines. The Russians, of course, continue to deny any plans to invade Ukraine. Futures right now just about unchanged on the S&P. On the Nasdaq 100, just about positive, up 5 or 6 points, up not even 0.1%. To weigh in on all of this, looking forward to catching up with Mohammed Al-Arian, Bloomberg opinion columnist, and of course, Queen's College president. That's because you're not very nice to him, Tom.
I don't,
you just got to be kinder to people. Do you think Kelsey's going to come back now?
I like Queen's Park Rangers and
Mets. Tell him you like the Mets. He'll come on.
No, that's the problem. I don't like the Mets.
Well, there you go. Forget it. He's not coming on.
He's coming on in 20 minutes. This is Bloomberg.
Maybe I'll leave radio and come hang with you.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. The US now says that Russia has massed as many as 190,000 personnel in and around Ukraine. It calls it the most significant military mobilization since World War II. The US has ramped up warnings of a possible Russian attack on Ukraine. Russian officials say no invasion is planned. Now, the Internal Revenue Service is adding a second so-called surge team to expand its capacity to process US tax returns. That comes after criticism from members of Congress who say taxpayers are waiting for months to get their refunds. The IRS will also outsource some functions to help finalize returns quicker. The largest maker of farm machinery, Deere, has raised its outlook for the fiscal year. A boom in crop earnings is boosting farmers' demands for the company's iconic green tractors. Deere says it has been able to work around the global supply chain crisis. Shares of DraftKings are falling. The sports betting company added fewer customers in the fourth quarter than Wall Street had expected. That is despite spending hundreds of millions of dollars to attract new gamblers. DraftKings also forecast a loss of up to $925 million. Bloomberg has learned that traders at UBS will see their bonuses cut by about 10% on average. The Swiss bank's market unit took an $861 million hit for the collapse of prime brokerage client Archegos Capital. Overall, the bonus pool for UBS employees will increase by around 10%. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
What do you think is the impact of the Prime Minister on the market?
As Mr. Suzuki, who is the Financial Services Minister, he mentioned at his own press conference, and share buybacks is widely used to return profits to shareholders and improve ROE. And how to share out the profits from growth is totally the decision of the management of each company after carefully taking all the stakeholders into consideration. And I believe Mr. Kishida has a quite cautious stance on the uniform regulation of share buybacks. And I think because he is giving a consideration to each company's individual circumstance and decisions.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
I think as we shift away from goods spending back to services spending, and of course, services spending isn't back at trend yet, I do think that takes off some of the pressure that has been felt on inventories. And obviously, the supply chains having been or getting resolved a little bit.
Quite good yesterday. Gargi Chaudhuri with us with BlackRock, and I'll tell you, she is against consensus. She was adamant. Forget about the 6-7 rate hike ballet with all the Fed speakers today. We'll see where that stands as we go to the close at 4 p.m. Please stay with Bloomberg Radio, Bloomberg Television through the day on Fed Speak. We now digress to retail. We may be amateurs, but we are certain it is original what we're doing in retail America right now at every price point. Steve Sadoff invented much of what you perceive in modern luxury retail. I've always said Steve Sadoff of Saks Fifth Avenue flat out invented the word exclusive. He is now senior advisor to MasterCard and former chairman, I should say, and CEO of his Saks Fifth Avenue. Steve, it is extraordinary. And it is about rampant, I use that word carefully, rampant price increases at luxury. Have you ever seen this before?
No, I haven't seen it in years. The luxury sector is strong. You saw growth in the mid-40s in the month of January. You see price increases going right and left. And they're pricing, obviously they have supply chain cost increases, but they're pricing at margin. They're pricing in some cases above margin. They're raising their average units. And this is not just at the very high-end luxury. I think at accessible luxury, you're seeing a lot of increases in pricing. And the reality is the consumer is paying. The high-end consumer wants to spend money on themselves. They haven't been traveling. International travel is way down. And they want to treat themselves. They've been stuck at home in the pandemic. And you're seeing it come about in terms of the luxury spending. But you're seeing it broadly in terms of overall spending. I thought that you might start to see a slowdown in January, And the reality is that the consumer has been strong through the fall season and strong in January.
So, Steve, let's take this wider. This is absolutely critical. And I go to Feldman at Dana Telsey's group today, who said, look, Home Depot's getting it done. Home Depot's not Tiffany's. But with that said, Steve, do we miscalculate the slowdown? And can you, like James Bullard, Fed Bank president of St. Louis, can you say economic growth will be better based on what you see at MasterCard?
Right now, I'm seeing a strong consumer. You saw a 7% growth in January. You saw, let's call it high single-digit growth through the holiday season. And this was across segments of the consumer. So I believe, and it's in store as well as online. Online has grown, let's call it 60% since the beginning of the pandemic. The brick and mortar is back. People are back in department stores. I don't know that I see that slowdown yet coming. Now, clearly, you had the child tax credit stop. You have the markets that are volatile right now. There's the rising interest rates. So are there clouds on the horizon? Of course there are. Supply chain is starting to ease a little bit, but I think that you're in a situation right now where inventories have been in line. If inventories start to rise a lot, you're going to get back to this discounting in the fall. So I'm a little bit worried about where the consumer is going, but it hasn't shown up as a weakness yet.
Steve, is the signal different from the low-income individuals and the high-income individuals?
I don't think you've seen it yet. I think that because you had the support programs running through essentially through January with child tax credits, I have not seen that bifurcation. I would expect that you're going to start to see the middle of the market to the lower end starting to take a hit as you go into the year. Obviously, the high-end market's volatile in the stock markets, but right now it's been holding up really well. If you look at and I'm just using examples, whether it's the dollar stores or the outlet off-price sellers, they've been holding up really well. The luxury holding up well. Department stores have had the best performance in years. You saw 10% growth through the fall season in the department stores. So this is an economy where the consumer economy has been booming. Again, you don't have people traveling. You don't have airlines. Hotels are still constrained, and people have been buying stuff. And there's still a little bit of pent-up demand relative to the availability of some of the categories. So I would expect to see it continue for a bit, but there certainly is some questions about what happens as we go into the middle of the year.
I was noting that apparel sales, as you put out there, were up nearly 40% in January year over year, which is a record in the data that you've collected going back years. Are there certain areas that are driving some of the spending that will fade back? What do you see for the composition of consumer expenditures throughout the remainder of the year?
Well, I think we're in an apparel moment, and it's really interesting. People have been pent up at home. They've been wearing their sweatpants. Now they want to get out. They're going to events and parties, but they're not dressing the same way they used to. It's not the same suit that they're wearing. You want fashion, you want newness, but you also want comfort. So there's a whole new styling that's going on, and those tend to last for several years. So my guess is that the apparel sector is going to hold up really well in the next year or so. So that's one where I feel good about, which could be good for the department stores. And it's going to be good for the specialty apparel retailers. Clearly, sectors that are the get back to outside, the restaurants, the experiential categories, the travel are going to start to recover strongly as we move from pandemic to endemic phase.
Steve Sadoff, thank you so much, with MasterCard, their senior advisor. Lisa, many stories going on right now, but the lead story here, and moving the markets, moving ruble, moving Swiss franc to a stronger Swiss franc, are Putin and his near abroad neighbor of Belarus, Mr. Lukashenko. And the one headline, Lisa, I'll let you decide what you like here. Lukashenko will decide with Putin on my presidency. That is a stunning headline.
Yeah, also Lukashenko talking about how he discussed economic sanctions with Vladimir Putin. In this headline, Vladimir Putin saying, I didn't pay attention to invasion reports. You know, there's this question about going forward, how they're going to message the imminency of some sort of invasion, with the U.S. is pushing that kind of narrative and Russia very much pushing against it. The market reaction, though, Tom, is interesting. We saw some concerns peaking about individuals, citizens, non-military personnel being moved out of some of the rebel territories in Ukraine. That was Interfax reports. But the interesting thing to me is that we saw an immediate response in equities, a rolling over, and how much people are ready to respond and pounce if there is some sort of altercation is something that indicates how much people are not pricing that in right now.
I'm going to go to ruble, which pulled back from the good news of the last 12 hours. Ruble weaker, back to where it was roughly 18 hours ago. Not a big deal, I guess. But I would look at the curve flatness of the United States. The vanilla curve, the 2-10 spread is at 46.70 points, nowhere near the angst of Monday and Tuesday. But nevertheless, the curve flattening here harkens back to where we were 24 hours ago. It will be an extraordinary weekend. Lisa Bramwitz and I and John Farrow really would like to say thank you to our team, and particularly for the efforts to give you this morning Elizabeth Economy, Robert Hormats, and Seth Jones. A spectacular day of international relations for us. Stay with us. The story continues here on Bloomberg Radio and Bloomberg Television. Good morning.
Soaring energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Here in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
To recap the headlines.
You do not want to miss this story.
How are you thinking about those dynamics? As a company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
We are giving up the overnight gains this morning from New York City. Good morning, good morning. Your equity market dead flat on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue, whipsawed by headlines.
The headlines have just been flowing fast and furious.
The Ukraine headlines. Markets know that this is not good.
Markets are clearly up and down,
struggling to connect the dots and really understand how bad this is.
The developments between Russia and Ukraine.
People are feeling nervous. This is a big air pocket of uncertainty,
which clearly has been bleeding into volatility.
We do see more tensions.
Any sort of serious escalation.
If Russia does invade Ukraine,
all bets are off.
50 bips is completely off the table.
Another reason why the Fed's going to be very, very careful.
Anything can derail this Fed.
So there clearly is downside risk.
That's the kind of thread the market is pulling on right now.
Team coverage right now with Bloomberg's Maria Tadeo from Brussels, alongside of Bloomberg's Anne-Marie down in D.C. Maria, an ongoing press conference with the Russian president and his counterpart in Belarus. What are you hearing?
Well, here's the thing, Jonathan. This press conference by Putin, but also Alexander Lukashenko, it is very important in many ways. You know that Lukashenko has been in power since 1994, I should say. But of course, the only political ally that he has at this point is Vladimir Putin. Now, the goal of this press conference, but also the meeting the two have had, is to decide what happens with the military drills and the military exercises in Belarus after Sunday. Now, of course, you have to look at the map. Belarus is a country that is located between Russia and Ukraine. If you want to attack Ukraine, Belarus could be a good starting point. Now, a number of things that I'll be watching out for here. One is whether or not the Belarusian leader decides to keep the Russian weapons on site, whether he decides to extend them, whether he's open to more military drills in his country. And then, of course, yesterday in full military gear, he gave a quote that really has sent a lot of concerns in Europe, saying, if we feel we need nuclear weapons in Belarus to protect ourselves, if Vladimir Putin asks us to host nuclear weapons, that is something that we would consider. Of course, again, you have to go to the map. This is a country between Russia and Ukraine. For the Ukrainians, it makes them incredibly nervous, the prospect of more weapons in a country that is so closely connected. But also, Jonathan, and this is the key, so politically dependent on Vladimir Putin. If he asks a favor, you best believe Lukashenko will say yes.
AMH, let's go to the map and let's go to eastern Ukraine. The reports from Interfax this morning suggesting that Russian separatists in Ukraine rather, are evacuating the elderly, children and women back to Russia. That's when this equity story started to fade. It built up yesterday evening, as you know, once we scheduled a meeting between Minister Lavrov and Secretary Blinken for next week. What's the order of events now, Anne-Marie?
Yeah, so a lot of diplomacy happening at the moment. Just 30 minutes ago, Jonathan, the defense minister of the United States spoke to his Russian counterpart, Sergei Shoigu, and he tweeted that he called for the de-escalation. Then we have next week, Blinken and his counterpart, Lavrov, expected to meet in Europe. Interesting, Jonathan, the State Department says there's preconditions to that meeting. As long as Russia does not further invade Ukraine, they are ready to meet. And then also, Olaf Scholz, the Chancellor of Germany, is calling for a G7 next week. And the President of the United States today will be talking by video or phone call to transatlantic leaders to talk about Ukraine. You can see the concern rising when it comes to the diplomatic path. But I have to say, it is a good sign that channels of communication are open between Moscow and Washington. There's something else, Jonathan, that is slightly worrying to the White House and to the United States as a whole, and that is the Organization of Security and Cooperation. The U.S. ambassador to that organization, Ambassador Carpenter, said that the Russian forces right now are anywhere between 169 to 190,000, just under 200,000. Now, this also includes not just troops, but other personnel like National Guard and those Russian-backed separatists. But Jonathan, he notes that this is almost a twofold, a double increase from January 30th.
AMH, thank you. Down in D.C. And Maria, as always, stay close alongside Maria Tadeo down in Brussels. That's the story of the moment, isn't it? Claims and competing claims. NATO members say the troop build-up has continued. It's not back down. Russia says there are no plans whatsoever to invade Ukraine. And for market participants in our world, and that's the focus of this show at the end of the day, stuck somewhere in between. Futures right now going nowhere. They were positive overnight. Let's get to Mohammed Al-Arian, the perfect guest to discuss all of this, of Bloomberg Opinion and, of course, the Queen's College Cambridge president. Mohammed, I want to start here and fold this into the Fed, because that's what a lot of people are grappling with. If this led to an energy spike, would it lead the Fed to need to do more, need to do less? How are you thinking about these kind of issues influencing this central bank?
So first, it is really uncertain, and that has to be put first and foremost. You know, you talk about the micro issues. We hear competing news. There's also a macro issue. The market so far has been trading in a relatively range-bound way because the market believes it's either going to be resolved by a diplomatic effort, or alternatively, it will be no war and no peace for a while. The market hasn't really embraced the possibility that it could be an even broader range. So it's important to recognize that the uncertainty is even larger than what the market is pricing. As to the Fed, it will make the Fed more hesitant. As you know, I don't buy the 7 hikes for this year. I think that would be excessive. And I look at how the market has rushed to price this, and it just tells me that the Fed better get out there with guidance. Otherwise, they're really going to lose control of the policy narrative.
So, Mohammed, let me bring up the policy narrative and something Matt Hornback of Morgan Stanley said earlier this week. This was the quote. The markets are prepared for 50. If they deliver less than what the markets are hinting at in their price, then that will amount to an easing of monetary policy, and this is not the environment to be easing monetary policy, clearly. What would you say back to that, Mohammed?
So I would say he has a point. When policymakers don't validate pricing, you get a reaction. Now, normally you would get a positive reaction on risk assets because the Fed is being more dovish. But here, inflation is a problem, and it's not going to go away. And it just highlights, John, over and over again, the corner that the Fed has put itself in. This is self-inflicted because it waited so long and it kept for way too long the mischaracterization of inflation as transitory. So we are in this world of second and third best, as you and I have discussed, and it's not clear how the Fed gets out of it. So I think he's right. But what about the opposite? What if they go 50? Will the market then price in the next one as 50 as opposed to 25? We don't know.
You said something important, though, just at the start of that comment, and it's something that reminded me of what Bob Michael of JP Morgan Asset Management said earlier this week. This idea, Mohammed, that if they don't get control of the narrative, if they don't go big, that typically what you would get, and this is more intuitive, a Fed that's more dovish, great, by the market. Bob's suggesting, Mohammed, and I heard you suggest it too, that maybe you get adverse reactions in risk assets because there is a belief the Fed does not have a handle on this. Can you build that out just a little bit more?
Yeah, the nightmare for the marketplace is stagflation. It is a tail scenario, but it is an impactful tail scenario. So how do you get stagflation? The Fed underreacts. It doesn't get control of inflation expectations. Inflation expectations get seriously de-anchored. And next thing you know, the Fed then has to slam on the brakes, but inflation is still on the way up. So the marketplace gets hit in 2 ways. And of course, the economy gets hit in 2 ways, by inflation and by stagnation of economic growth. That is the nightmare. So that's how delicate this whole situation has become. And the Fed sort of has to work that. I worry, and let's hope today this changes, I worry that we've had absolutely no remarks whatsoever from the top leadership of the Fed. And the more quiet they've been, the more the policy narrative has escaped them.
Well, let's think about who we hear from today. We hear from Governor Waller. He's been outspoken before. Then we've got the core of the Fed. We hear from Governor Brainerd. We hear from President Williams of New York as well. Mohammed, you've done a brilliant job of showing how the window is getting smaller. You've done a fantastic job of forecasting this as the data evolves, particularly through last summer, when you start to become more alarmed about what the future might hold. What I need from you that we haven't got yet from you, Mohammed, is what you think the optimal policy response actually is from here. You've said the window's smaller. I get it. What do you think they actually need to do? If it's not 50, what is it?
So, John, when you're far away from the world of first best, there is no optimal policy response. And that's really important to note. There is a less bad policy response, but you've given up on the optionality of an optimal policy response because when that window was open to the Fed, repeatedly, they didn't go through it. They didn't do anything. So there is no optimal policy response. It's a matter of how do you minimize the unintended consequences and collateral damage. Listen carefully today to John Williams. He's part of the Troika, Jerome Powell, Lael Brainerd, and John Williams. His speech is about the economic outlook. So he cannot avoid talking about policy. So that's the one that you need to listen to today.
There isn't an optimal one. What's the less bad one?
So in my view, I'd rather let inflation run higher for longer, believe it or not, than slam on the brakes and risk a recession. Okay, but it's not an easy path. And that's the sort of judgment they're going to have to make. I truly believe that if we get 7 rate hikes and we get QT, this economy will not be able to absorb this. This economy has been conditioned for so long to live with liquidity injections and floored interest rate that this would be too dramatic a change for many parts of it.
What I hear from you then, Mohammed, is that there is no soft landing. Is that a fair characterization of what you're saying?
There's no long-term soft landing. You can have the appearance of softest landing and push back the problem into next year, but ultimately you're going to have to deal with the fact that the Fed has fallen behind inflation, and now it simply has to not optimize but satisfies, and that's a very different policy regime.
Can we turn to the market consequences of that? Mohammed, if you're saying you believe the less bad response, not optimal, but less bad response is to allow inflation to run hotter for longer, because ultimately they've got no choice. If they do the 7 that it might take to bring this down and bring it down quickly, we'll end up in a bad place. What are the market consequences of that, Mohammed?
So there's a good part of the market that believes in a couple of things. It believes that supply chain disruptions are going to solve themselves quickly. They will ultimately solve themselves, but it's too quickly. And it believes that there's a productivity gain around the corner. So for that part of the marketplace, okay, it will be fine to go slow by the Fed because they believe that we have self-corrective elements into the marketplace. There's another part of the marketplace that says, actually, this is not happening fast enough. The bottom line, John, is we're going to continue to see a lot of volatility. And it's not just, there's a tendency to think this is just about Ukraine and Russia, but there's much more than that, as I'm going to argue in the Financial Times next week.
Your promo for the FT next week, Mohammed, on this show. Mohammed, really? You're not going to give us a hint, a tease of what's in the article?
No, because then you wouldn't read it. Not that you read it anyway, but you wouldn't read it for sure.
I always read it. Mohammed, we'll leave it there. It's good to catch up. I look forward to the piece over the weekend and into next week in the Financial Times. Thank you very much, sir. Futures turn a little bit negative on the S&P 500. I want to get you some single names, some movers, and we can do that with Abby. Hey, Abby.
Hey, John. Well, keeping it simple with the macro picture, we do have the NASDAQ 100 futures up slightly more. So not surprisingly, Apple and some of the other big tech names are up. But that's true, too, interestingly, for the banks. Yields are down, so that helps out big tech on valuation concerns being alleviated. But banks typically would fall, as they have been with yields down. That's not the case today. Energy, however, falling once again, down for a 4th out of 5 days. These energy stocks, ExxonMobil in particular, down 1%. But, of course, earnings season continues. Deere is popping as they've raised their outlook as usual. Roku, on the other hand, absolutely plunging. They've blamed their supply chain for the miss. And then DraftKings also down 16%. They upped the outlook, but not much. So a case of a high bar quarter, just not delivering.
Abby, thank you. Coming up on the show, Fed officials facing the pressure of higher inflation.
To put downward pressure on inflation, you'd actually have to get to neutral and go beyond neutral. We have to get in a position to do that at some point.
Looking ahead to March, that's next.
Is this going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project. Initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Season continues.
To the metaverse, to Spotify, to Qualcomm and beyond.
Bloomberg is fastest with the numbers and analysis.
Peloton becoming a proxy for this pandemic.
I think there's tremendous opportunity.
Bloomberg, the fastest numbers and analysis you trust.
This is a lot of inflation for the U.S. Markets are, I would say, losing faith to some degree that it's going to dissipate in any reasonable amount of time. So without Fed action, the best response to this situation is to front load the removal of accommodation. Let's set a target that we try to get 100 basis points on the funds rate by July 1.
This sets up a really interesting conversation for next month on March 16th. There's President Bullard talking up front-loading rate hikes. Here's Loretta Mester of Cleveland, the Fed president there, saying the opposite. If by mid-year I assess that inflation is not going to moderate as expected, then I would support removing accommodation at a faster pace over the second half of the year. So not front-loading the year, but maybe back-loading the year. Mike McKee, I'm confused. Are you?
I'm not actually, John. When you parse what Loretta is saying, she's basically saying we do move in March, and then a couple times after that. And then we'll see whether inflation is starting to come down. So if you take a look at what they're talking about in terms of rate moves, Jim Bullard is obviously talking about, because there are 3 meetings between now and July 1st, he's talking about 100 basis points. He's got to go 50 at one meeting. But Loretta Mester is talking about 75 basis points if she wants to do 3. So it's really that 50 basis point move that's out there that they have to decide whether or not they want to do. And at this point, it doesn't look like Mester's on board with that, but she's willing to watch the data. They do agree that you want to raise interest rates, and March seems to be on everybody's calendar now, so I don't think there's any doubt about that. They want to reduce the balance sheet, and Mester did add to her comments that maybe they do sell some mortgage holdings. That's something that Bullard has suggested, and they're going to have to end forward guidance. They all agree, because they can't really tell you what's going to happen going forward until they see what happens with inflation. So a change in policy there. Now, at mid-year right now, here's what economists are expecting. 7% inflation here in the first quarter, but when we get to the end of the second quarter, it's down to 5.8%. How is it moving? What's moving? All that will play into it, but is that enough of a move that Loretta Mester would then think that they should slow down, or would Jim Bullard think they should speed up? Those are the questions that are still out there, and a lot of that's going to depend on COVID. It's going to depend on Russia and the Ukraine. It's going to depend on supply chains. There are many, many things out there that they don't have answers to right now. Energy prices. Inflation could be way high because of Russia invading Ukraine. We could be well over $100 a barrel, and yet raising interest rates isn't going to help with that at all. That's a lesson from the 1970s. So it's kind of understandable that they're going to have different positions once you get past the March meeting.
Looking ahead to March and beyond, Mike McKee, thank you, sir. Fantastic lineup to guide us through the opening bow now. Bank of America's Jill Carey-Hall, JP Morgan's Jack Caffrey, Morgan Stanley's Sri Sankaran. Jill Carey-Hall, to you first. Bank of America doing a really great job of just outlining what you think is going to happen this year, and the market's just come right to you. Ethan Harris at 7 hikes for 22. We've got Market Banner looking for $1 trillion of balance sheet reduction this year, again next year. Jill, what does that mean to the equity market?
Hi, John. Thanks for having me. Yeah, I think we are expecting a volatile year for equities, and we've had a 4,600 target for year end on the S&P 500. So, look, I think it'll be a volatile path to year end. When you look at the Fed balance sheet reduction, I think that's more important for equities than just the 7 hikes that we're expecting. Pretty limited relationship between market returns and the Fed funds rate itself. But Fed balance sheet and Fed liquidity has been a major driver of S&P 500 returns. So, based on that liquidity framework and what we've seen post-crisis, that would also suggest, just based on that Fed balance sheet reduction, kind of a similar level to what our target is implying, 4,600 for year end. So we would focus on opportunities within the market, areas that have historically fared well during late cycle or when the Fed's hiking. We prefer cyclical growth over secular growth. We like stocks with healthy free cash flow, and we continue to prefer small caps over large caps.
Sri, the line from Bank of America, we're tightening into an overvalued equity market. Are we doing the same thing into credit?
I think that's fair. Credit's had a valuation problem for some time now. But I think some of the justification with respect to the credit markets has been that the metrics which drive the fundamentals obviously are a little more slower moving than what you see in the equity markets. And if you look at where balance sheets are in terms of net leverage, the cash balances, et cetera, it is the cleanest going into a hiking cycle. But the debate here is, or the tension here is just going to be around the fact that the starting point is great, but the pace at which things are going to change is also going to be kind of extraordinarily aggressive. So to that extent, the credit market doesn't have a problem right now in terms of fundamentals, but there is a lot more uncertainty with respect to the future, and the valuation problems to some extent is being solved for, given the magnitude of the moves that we have seen over the past month or so.
Let's talk about the future, Jack. Michael Hartnett over at B of A wrote this morning. We're bearish tech, stocks, credit. The next 6 months, rate shock morphs into a recession shock. Where are you on that now, Jack? Does any of that resonate with you?
I certainly think that as we move through this year, you're going to see more pressure on what I would call the tails of the market. On the secular growth side, higher interest rates, more pressure on valuations, slowing earnings growth. And what you've certainly seen is some earnings news which points to a normalization of spend on the part of some of the secular growth names actually cutting into their earnings estimates. On the other side, if we start getting slower growth, some normalization, I do think you're going to see some pressure on the deeper cyclicals. And so ultimately, I think the core of the market, higher quality, is where it wants to be from an investment perspective. But I would also say when we look at volatility overall, this year is probably going to be trader's paradise. There's just going to be volatility, whether it's in yields, whether it's going to be in credit, whether it's going to be in the equity market, and nimble positions are going to be able to trade around that. And I think they're going to be adding value as well. So it's either stay the course, true to your terms, or look for where markets are overreacting and trying to be contrarian.
You know we're going to use that line on Trader's Paradise on repeat through the rest of this year, don't you, Jack? That's perfect. Jack Caffrey's going to stick with us alongside Sri Sankaran and Jill Carey-Hall. Coming up, the morning calls, and later, shale giants pledging to limit production hikes even as crude edges towards triple digits. Pioneer on Bloomberg yesterday. We get to 150, 200. It doesn't matter. We're not going to move. We'll talk about that next. From New York, this is Bloomberg.
At the Delhi airport, and behind me you can see SpiceJet's 737 MAX aircraft. Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
5 minutes away from the opening bell. As this session grows older, this bounce fades. The overnight bounce is gone. The S&P 500 unchanged. Similar move on a Russell. The Nasdaq up by just about 0.2%. That's the equity story. Here's the bond market picture. Yields coming lower through this morning. 10's down by 2, off by almost 3 now to 193.55. You can call it just about 194. That's the price action here. The morning calls. Let's get straight to it with Pivotal Research downgrading Roku to a sell, expecting slower revenue growth amid increasing competition and a weakening global economy. Barclays cutting its price target on Intel down to 45. They trimmed their estimates following lackluster commentary at an investor meeting. We're down there by 2.8%. Finally, your third and final call from Raymond James, upgrading Fastly to a strong buy, seeing an attractive buying opportunity after recording its biggest one-day drop on record on Thursday, up now by almost 3% or so. Coming up, Pioneer, Devon Energy, among shale giants that are not looking to pump more crude.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
25 seconds away from the opening bout this morning. Good morning to you all. We're almost there. A long weekend in the States just around the corner. Futures are unchanged on the S&P. They were positive overnight off the back of a scheduled meeting between Secretary Blinken and Minister Lavrov. The tone since then, we've unwound a lot of it. Unchanged on the S&P, just about positive on the NASDAQ. There's the opening bout. Switch up the board and get to the bond market. 10-year yields come in 2 or 3 basis points to 193.72. Euro dollar 113.46. We're negative there, a tenth of 1%. In about 90 minutes from now, we'll hear from President Williams of New York, then on to Brainerd later on this afternoon. The Fed speak front and center for a lot of you, I know. Curious this one, crude, 89.47, a break in 90 to the downside, negative 2.53%, call it negative 2.5. On the week, the biggest weekly loss of the year so far. And let's be fair, a weekly loss for crude right now is tremendously rare. At the opening bout, then about 30 seconds in, we're just about positive on the S&P by almost a tenth of 1%. Energy, the big loser this morning, down by a little more than 1%. Information technology, getting a bounce, a kick higher from yesterday's big losses, up 0.4% on IT. Let's get you some movers. Let's get to Abby.
Hey, John. Well, the earnings season continues on, even though perhaps less well-known names. But one big name is helping that S&P 500 with that fractional gain. And I'm talking about Deere. Shares are popping higher after they put up a very big beat. And more importantly, actually, now the stock is lower. That's interesting because it had been sharply higher, but now trading lower. It was a great quarter, though, and they boosted the outlook once again on farm demand. We'll have to be looking into what's causing that turnaround, that decline to the downside. It could be some of the other earnings movers, or maybe the sentiment. It's hard to know. In terms of some technology names that are moving to the downside, let's take a look at Roku, absolutely plunging. They missed and their outlook disappointing, blaming it on the supply chain, which is interesting given the fact that only 19% of their revenue comes from goods sold. Shake Shack down 13%. They put up an ugly quarter, huge miss, the outlook disappointing, and their guidance really is signaling trouble ahead to some. And then finally, DraftKings, also another ugly name here. Users fall short. Their forecast is for a loss. They're not seeing a profit until 2024. So overall, a little bit of a rough day for these earnings movers, and I will be looking into Deere and what caused that turnaround. John.
Abby, thank you, and we'll touch base with you before the show on that too. Thank you very much. 2 minutes in, taking a look at crude as well. Brent right now, 91.17. WTI, 89.59. Heading for the first weekly decline in 2 months. Katie Lyons, it has been a while.
It has definitely been a while, and there's a lot of stories playing into this, shall we say, especially on the geopolitical front. On the one hand, we continue to monitor risks around the Russia story and energy output from that big oil producer. On the other hand, there is the issue of Iran and the potential return to a nuclear deal and more supply coming onto the market from that country. So it's a lot to weigh. Obviously, crude moving to the downside this week, but we have to consider how far we have come already in 2022. We started around $75 a barrel on WTI. We're now in and around 90, up about 20% year to date, and it's really across the energy complex. You have natural gas futures up about 24%, and all of that adds up to big gains for the energy sector as a whole. It is far and away the best performing in the S&P 500 this year, up about 22%. So oil prices helping energy companies, but it is energy players that are also propping up oil prices in that they are still keeping supply constrained, even in the face of this demand recovery. We know OPEC Plus has been very slow to add barrels back onto the market, maintaining that steady 400,000 barrels a day increase every month. But it's not just about the cartel. It's about this shale patch as well, which actually the U.S. was the largest oil producer in the world in 2020, about a 20% share. And it used to be a drill baby drill story when it came to shale, John. A lot of investments in production, pumping more crude, more production capacity. But that has now shifted to a story of discipline, controlling costs, returning capital to shareholders. It's less about pumping as much as you can. The question really surrounds how long that is going to be the story if we see oil prices continuing to climb. What happens if we hit triple digits? Is it just too enticing to start drilling more, John?
Kelly, thank you. And can I just say, wonderful interview yesterday. Just fantastic. Thank you so much for that. Alongside Guy Johnson, with the Pioneer CEO. Take a listen to what he had to say about crude. 100, 150, 200. What would bring him back?
Regardless of whether it's $150 oil, $200 oil, or $100 oil, we're not going to change our growth plans. Even if the president wants us to grow, I just don't think the industry could grow anyway.
Back with us, Jill Carey-Hall, Jack Caffrey, Sri Sankaran. Jack, first to you. You talked about the cyclicals briefly. Energy's been a massive winner for this year. Is that music to your ears when you hear someone in a shale patch saying, I don't care what it gets to, 150, 200, we're going to be disciplined?
this is an industry which has historically struggled with its discipline. And so to the extent that they continue to talk discipline, that's a very powerful statement. They also recognize that there's been tremendous pressure on, if you will, eroding demand growth into the future. And to the extent if you were in the political sphere, higher prices actually might encourage people to make that transition that much faster. But they also, I've had some concerns if we've had a labor force that could have a housing boom, an infrastructure boom, and would you have workers for energy? I think what you're hearing from the energy companies is we don't want to incur higher costs at this point in time. And I think lastly that there's some concern how much of this current oil price that we've seen has got a geopolitical bid to it, and that could ease. I think when you look at that gap between oil prices and natural gas prices, it suggests that there's some larger than usual amount of geopolitical risk in the oil market, which isn't in some of the more domestically oriented energy sources such as natural gas.
So even if we do strip out the energy conversation for a moment, and Jill Carey-Hall, we just talk about prices and where the pricing power is, your world, the small caps, do you think there's more pricing power there than what you're seeing maybe concentrated in the S&P 500?
Yeah, surprisingly, when we've looked back, historically, small caps have fared very well in periods of elevated inflation. We've seen that their margins have surprisingly been less negatively correlated with some of the inflationary forces like labor and CPI than large cap margins. And we've continued to see that show up in recent earnings seasons. So when you look at the mentions of pricing power on earnings calls, you actually saw more positive trends mentioned by small cap companies than large cap companies. So, yeah, I think this is a space that we continue to like, that we are expecting inflationary pressures to ease as we move throughout this year. But certainly labor is something that has been a risk, especially to more labor intensive areas of the market. So pockets of consumer, pockets of industrials and healthcare. For the S&P 500, consensus is expecting that we could see a return to record margins this year. So that looks a bit optimistic to us and is one of the reasons we've been below consensus on earnings.
I think you're not alone. I think that's looking optimistic for a lot of people. Sri, we're looking at higher costs, maybe higher energy costs. We're looking at higher interest rates as well. Sri, I've been looking at the work you've been doing, and it's tremendously detailed. So forgive me that we've only got a few minutes to work through this. Just on interest coverage ratios, and typically how they respond as interest rates start to climb, how credit performs in a typical rate hiking cycle, and how typical this one isn't. Sri, can you run us through it?
Yeah, I'll try to be very brief. So the historical precedent of the playbook has been that coverage ratios do not really deteriorate early in a hiking cycle. So the logic here is that you do get that earnings momentum offset some of the increase in interest expenses. And that's why in the early part of a hiking cycle, what we have seen historically is interest coverage ratios improve, even for the leveraged loan market, where it's floating rate liabilities that we're talking about. What is different this time around, though, obviously, is the fact that, yes, the coverage ratio is probably for the loan borrowers, it's not really as high as it was kind of at the beginning of some of the earlier cycles, but it is a very healthy number that we're looking at. The key issue here is going to be the pace of rate hikes, and it's not necessarily around how quickly interest expenses go up. It's more to do with the fact that when do they start acting as a drag on earnings growth? And the concern here is that because you're looking at a Fed that's trying to control inflation, do they compromise on the growth outlook and create more uncertainty around the earnings outlook? I think that's the key when we're thinking about how coverage ratios evolve in this cycle.
When you think about that internally around the table at the moment, Sri, have you come to a decision, a base case with any confidence whatsoever?
No, a lot of debates, but I think it's still, what we are comforted by is the fact that the starting point is healthy. What we're debating is kind of how much of a balancing act the Fed can pull through. And to some extent, it feels like it's a little early to kind of conclude that corporate balance sheets are going to go through a significant downturn just yet. But we are aware that we can't just stay confident because of the starting levels being healthy. And there is also the nuance around, there's more debate around what the impact on the tail cohorts is going to be, because the portion of the market that is kind of over leveraged and has relatively low coverage ratios, that is also kind of still on the higher end, which is why I think the point would be that you need that earnings related healing to come through. And we haven't really kind kind of come to a strong conclusion just yet. There's just more uncertainty for sure.
And that's where we are in this market. And that honesty, that transparency of those conversations at the moment is why a lot of people are finding it difficult at the moment to put money to work. Jack Caffrey, one way people have looked to protect themselves against higher interest rates, quite naturally, is just to buy the banks. The banks have done quite nicely year to date on the S&P 500, up about 4%, maybe not the gains you might expect. You talked about pulling back from the cyclicals. Let's talk about the winners of the year. Certainly not IT. Jack, it's been the banks, much more so in Europe at times, and it's been energy too. Can we sit on the banks just for a moment, Jack, and get your thoughts?
You know, I do think the banks are clear beneficiaries of higher long rates. And so to the extent that we are going to see the Fed try to engineer a yield curve shift, and I think the emphasis might be try to engineer a yield curve shift to try to indicate that they have better control over inflation, then I do think the banks continue to work. I think the challenge is going to be to the extent higher rates impact the housing market, and the housing market is a key driver of bank lending, the extent you don't really have a lot of corporate borrowing as of yet because of inventory problems. You just can't actually incur the inventory. The loan growth, I think, is going to be the question, and loan growth is probably going to be tied back to corporate and consumer confidence. And so ultimately, banks work, and they have yield, and they are doing the right thing, and they are well capitalized. But I do think that they're going to be, to some extent, a leverage play on confidence.
Jill, final word on that, just on the banks, please.
We've been overweight financials within both large caps, and then they've ranked favorably in our small cap work as well. I mean, I think they also fit what's another theme we think is going to work really well within the market this year, which is quality. I mean, typically high quality stocks with stable earnings, which financials has become an increasingly higher quality sector post-crisis. Those types of stocks are what works when you see the Fed tightening, when you see volatility pick up, when you see profits growth decelerate. These are all backdrops where quality works. And so within large and small caps, we would stick with an overweight on financials.
Jill, thank you. As always, Jill Carey-Hall of Bank of America, Jack Caffrey of JP Morgan, and to Sri Sankaran for condensing, hours and hours of research on credit into about 2 minutes or so. Sri, thank you. As always, buddy, thank you very much. Your equity market's down about 0.2% on the S&P, 12 minutes into the session. Some big movers, Abby, to talk about just after the opening bell. Let's do that now.
Big movers indeed, John. And one of them is Roku. Shares absolutely plunging down more than 20%, headed to the worst day ever since this company has traded publicly back in 2017. And it's interesting, they beat on profits, but they put up a 3% miss on sales. They also gave a disappointing guide. They're talking about issues with the supply chain. This is interesting only because 19% of their sales is from goods, whereas the rest is from programming. So it's hard to know how programming is affected by the supply chain. But in any case, the street is pretty bearish on this. We have some downgrades. Pivotal Research is now at a sell. They're saying that the bearish view reflects an increasing competition, a potentially significant weakening global economy. So there's a bit of a macro call there, too. MoffettNathanson already at a sell. So a bearish day for Roku here. Not entirely surprising in some ways, though, John, because ahead of today, this stock was already down more than 50% from its peak. So some investors were aware that there's weakness here. And it's really not even a bearish situation here from a short position, about 4% of the shares short. So just a brutal situation here for the shares of Roku, John.
It's a struggle in the early part of this morning. Abby, thank you. Coming up, Hong Kong, a struggle also, battling to get its COVID-0 strategy back on track.
In Hong Kong in early March, we'll most likely have many tens of thousands of infections.
That's next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
En nuestro estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
In Hong Kong in early March, we'll most likely have many tens of thousands of infections. I wouldn't rule out hundreds of thousands of infections that could be detected by this mass testing exercise. Where would those people go? Where would the cases be put? Because we simply don't have isolation facilities for that many people.
Hong Kong continuing to grapple with surging virus cases. The chief executive of Hong Kong, Carrie Lam, planning mandatory testing for all residents as China's COVID-0 strategy upends its return to normalcy. I'll bring back in Mike McKee for more here. Mike, we're testing all residents. That's 7.5 million people. It's a lot of people, a lot of work. Would you say here's a part of the world that's a few months behind where Europe and the US was with this and deploying a very, very different strategy?
It's more than a few months behind, John. You take a look at the chart, and it looks like Hong Kong is where New York was or Wuhan was when the whole thing first started. Nothing. And then all of a sudden, this gigantic jump up. And that's what Hong Kong is trying to deal with right now under the strictures of China's COVID-0 policy. So they're going to have to make some decisions about how to do this. As you mentioned, they're going to try to test everybody in the city next month. They've already got cases leaking over into mainland China, so they're getting pressure from the Chinese to try to do something about this as quickly as possible. But you heard the doctor, tens of thousands of cases could be happening by the time they get around to starting testing. Then you bring everybody together in one place, stand in line to get tested, and you've got some transmission problems there as well. So Hong Kong facing some real problems going forward. Where are they going to quarantine? The doctor mentioned, well, they're talking about having them in hospitals or hotels that are converted to hospitals for 7 days. Then if they test negative, they can go home and quarantine for the rest of the time at home. But this is going to be worse than Wuhan, they say, because there's so many people that have to be tested at the same time, and the cases are already spreading very quickly.
Mike McKee, thank you, sir. As always, that's a really important story to stay on top of. If you've been following the price action, you know what's been going on. If you haven't, let me guide you through it. Just a quick chart intraday of S&P 500 futures. You see the pop late last night on the S&P 500 yesterday evening. That pop came about because we scheduled a meeting next week with Secretary Blinken and Sergei Lavrov, the Russian foreign minister. This came from Ned Price, a State Department spokesperson, who said the Russians have proposed dates for late next week, which we're accepting. That meeting will take place in Europe. Gains. Then we started to roll over. And this report came from Interfax, which I'll try and translate for you in just a moment. Separatists in Donbass turned around and said children, women and elderly people will evacuate to Russia due to what they called an escalation of conflict at the contact line. This came from a report from Interfax. We heard from the president of Russia a little bit later on. He went on to say that Kiev just needs to discuss the conflict with separatists. This was in a joint news conference with his counterpart in Belarus. The president of Russia said, I did not pay attention to invasion reports. Russia themselves, as you know, continues to deny any plans to invade Ukraine. But when those reports started to come out just a couple of hours ago, futures rolled over to negative. And here we are right now, unchanged on the S&P and negative on the NASDAQ. Let's get to Anne-Marie in D.C. Anne-Marie, can you translate those reports that came from Donbass separatists, according to Interfax, what that means and whether we've had any response whatsoever from the U.S. administration?
So those reports from the leader of the so-called Donetsk People's Republic is about evacuating women and children from the region into Russia. Now, I believe TASS is also reporting, Jonathan, that President Putin thus far is unaware of this type of evacuation. But when you see a report like that, it does make you think, these are Kremlin-backed separatists, right? So it does make you think that there could potentially, or this could potentially be what the United States has said and been worrying about and flagging, that there could be a false flag operation. And we should note there is constant fighting in this region, although the last 24, 48 hours, the OSCE has said they've seen an uptick in that. So that's what I would say in terms of what is going on in eastern Ukraine at the moment. Jonathan, just one point. When you read that headline that President Putin said he doesn't pay attention to the reports about what the United States says regarding Russian build-out, I find that very hard to believe, given the fact you've seen his entire cabinet and administration come out and talk about that those reports are false.
AMH, a long weekend coming up in the United States. Over this weekend, as markets close on Monday, at least stateside, there's going to be some drills. Can you guide us through them, the kind of headlines, the stories you'd expect to read through the weekend?
Well, there are going to be drills tomorrow, and Lukashenko, the Belarusian leader, sat down with President Putin today, and they're going to be watching those drills tomorrow. I think it's important just to remember that these are technically military drills and exercises, and they do happen before. This is one of the biggest, though, we've seen joint forces between Belarus and Russia in Belarus, which geographically is concerning for Ukraine, because at the moment, what the United States is seeing is a buildup between 169 to 190,000 troops around that border. So I think just the financial markets will be closed, but this will, of course, have a lot of eyes on it, and you just have to really pay attention to all of the headlines. And Jonathan, it is going to be tit for tat in terms of the headlines between Washington and Moscow. I also believe I read that President Zelensky potentially, I think, is going to that Munich Security Council meeting. So it'll be interesting to see how many Ukrainians are actually not going to be in the country, because they're going to be meeting with European and Western leaders in Germany.
AMH, thank you. Looking forward to the coverage through today on Bloomberg TV and on Bloomberg Radio as well. All of this just keeping a lid on this equity market, for the moment at least. Unchanged on the S&P, just about positive on the S&P and on the NASDAQ. With your sector price action, here's Abby.
Hey, John. Well, there is that fractional gain for the S&P 500. Beneath the surface, it may suggest that that gain could grow because we have more sectors higher up top, communication services, as Netflix and Discovery really climb, maybe having to do with the Roku debacle. On bottom, energy down 0.4%. That's also the story in the week. Energy, the big lagging sector on the week. Most sectors down on the week as the S&P 500 heads to a second down week in a row, adding to that 8% decline on the year, the worst year since 2008. The year is young, but we also have the financials lower, communication services, and tech. So another brutal week for stocks here, John. And today, it's kind of right in the middle.
It's been choppy. Abby, thank you. Your trading diary up next.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
Despite all the chop, all the volatility, this equity market is down on the week, but only by a few tenths of 1% on the Nasdaq and a little bit more on the S&P 500. We turn higher now, 26 minutes into the session, by 0.25% on the S&P. That's the price action. Here's your trading diary. Fed Governor Waller, Chicago Fed President Evans speaking at 10:45. Williams and Brainerd to close out the week. They're the two to watch. Then the New York Stock Exchange closing for President's Day on Monday. US PMIs on Tuesday. Finally, US GDP and initial jobless claims next Thursday. From New York City stateside, enjoy the long weekend. A deep breath for you all. It's been a long one. This is Bloomberg.
The U.S. has announced it's moving 8,500 more troops to Eastern Europe. If they're not being deployed to Ukraine specifically, why is that so important, and does that risk further provoking Russia?
Well, there's two things going on. So what the United States recently announced is that we are going to put 8,500 troops that are part of the NATO response force on high alert. That means they'll be ready to deploy on a moment's notice should we need those forces anywhere in Europe to protect NATO territory. In addition, the United States is also looking at possible additional moves that they might make to move U.S. force posture into Central and Eastern Europe. The reason we're looking at that is because a lot of the members in that neighborhood in Central and Eastern Europe feel concerned. And so we are looking at what measures we might take in the name of reassurance and deterrence.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
Pepsi's Number Fever campaign in the Philippines winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in Sari Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking, and of course Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19 they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venergold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Venergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Wiener Gold didn't receive the harshest possible sentence. He was given 14 years in prison, but
Damn, Ben Mark shot this too?
Thinking that I'm getting too hot. Got 2 Glocks on each side of my crotch. First nigga play, get pop. Say your man shooter on go, I make a nigga stop. Only send shots at the top. Make it easier for the people in.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, 1 kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At 1 kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. Asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in.
Feeling like I'm floating to the ceiling, is it magic? Baby, tell me why you disappearing, is it magic? I won't never tell him how I did it.
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000!
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right?
What it do. Good morning, guys. I know I told everybody that I was going to be live at 9:45 and it's 10:45, an hour late, but things happen. I've been on the chat, so if you guys haven't been typing and whatnot, that's on you guys. Discussion has been open since literally 8:30 today. What I'm going to do now is literally the last 15 minutes, a quick market recap. A quick little discussion here. Of what's going on right now in the markets and what we could expect possibly sometime next week. So right now I have the SPY. So SPY, yesterday we broke up. Or today, it's in the process of confirming the break of the uptrend. So the uptrend was this right here, and it's in the process of breaking that. Maybe in the hourly you cannot see it as clearly. I mean, in daily you cannot see it as clearly, but in hourly you can see it as clear as day. This is the trend. I'm gonna touch that line, bounce, break. So we might see a break all the way down to this area over here. So 432, 432.50. Consolidate there for a little bit, because as you can see, we have previous price action here, and then from there it'll then determine what the long-term trend is going to be. Are we going to continue back up, or are we going to continue further down? Then again, the bottoms always get bought up, so it's going to stop somewhere around here, 423, I would say. Bounce around there and then determine the new path. Are we gonna bounce back up, or are we gonna continue this downtrend? That we would know, probably sometime next week, Monday, between Monday and Tuesday, it'll start showing, its true colors. But for right now, near future, Monday, we could see this open somewhere here, possibly waste time there all day on Monday, and then continue lower. Honestly, it could happen, it could not. It's a fun thing about this, because why do I say it could happen and it cannot happen? Because we have the cues down near support as well. So that means that even if it opens lower on Monday, it's not gonna be a drastic open. It's gonna be a very weak open. So it's gonna be kind of like today's. It's gonna be a 0.20 something or a 0.30 percent, a negative percentage, because there's really not a whole lot of room to go lower without having buyers step in and possibly take us out of this crap. There's so much shit going on here. Look, this was last couple of days. Breakout. Broke out the trend, which has been continuing the downtrend. Broke support, consolidated. See this little jump over here? Jump, broke. They fought a little bit, and now they're breaking out much lower. It's gonna consolidate here for a little bit again, and then continue. It's fat. This is for Microsoft. The only one that I didn't think that could go lower and has actually been going lower is Facebook. I see a lot of people, stepping away from this. This company is getting a lot of bad rap the last year, 2 years, bro. Still a good company, still a legit company. It's not gonna go anywhere. This is honestly, I feel like it's a temporary situation. It's only a matter of time before we bounce back and recover, Even gold is being sold off. And typically a day like this, if we were really stepping into like a new bearish downtrend, or changing the entire uptrend as is, gold would have been bought up a whole lot more than this. This consolidation today is honestly unnecessary. It's an indication that the market itself doesn't even know where it's headed. So what's going on here might not mean anything. Might just stay around there, bounce back up on Monday. See, this is why the market, there's so many variables, there's so many things that could go on, that when it comes down to it, all you could do is play the odds. Because I can sit here and come up with 100 million different scenarios of where this is going to be taking off to, and then be 120% convinced that it's going to do that, and then Monday does completely the opposite. So never be too sure. Always be open and receptive to what the new information that the market is constantly feeding you. Don't go off one thing. That's where, you know, you get bit in the ass. This is one that has me confused. Two topping toes the last 2 days. This is a very, very bearish indication that it's going to be sold off. This uptrend is over. We're going on a downtrend. And what's happening? It's holding that support today. It's same candle. Even though this was green, is the exact same candle pattern. And it literally means that we might be headed in the same, we're still headed in a downtrend. But that goes to show you that there's no deciphering this thing. There's no telling, Just when you thought this was gonna sell off, it opened right next to it yesterday. It played around it all day, consolidated all day. Opened lower today, but now it's consolidating again. So if we would have bought a contract yesterday, which I did, this is now gone. This is now negative 100% or 98%. So just playing the odds. I'm good. Yes, my contract is worthless. Yes, I lost all the money that I put into that contract. Did I blow up my account? No. Is my account affected by it? No. Am I going to be trading next week? Fuck yeah, I am. Can I trade right now? Fuck yeah, I am. And make that money back. So it's all in risk management. Having a trading plan, a good trading plan is gonna put you and get you out of situations like this. Okay. So that when the market does not go your direction and it kills your contracts and it just wastes your time and eats your money away, you're still in the fight. You haven't blown up your account. You're not discouraged. You're not sad. It's just another day, and it's part of this. It's part of investing. But I mean, just with this alone, you have it. Like, there's no real direction in the market. You could sell off, maybe 1% sometime today, but it won't, since the VIX is so high, it won't be good enough for us to make any profit that's worth taking the risk of, for example, buying a contract with same day expiration. If that stock does not go your way, if that contract does not start valuing right away, time decay is going to eat up that contract within 30 minutes, within an hour, and your investment is going to go from whatever you invested to negative 80% within an hour. So it's very, very crucial to not only get the right pricing within the contracts, but also buy when the market and the market conditions are right enough where a slight little move in the direction that you just bet with is going to value your contract. So we have the VIX extremely high. This makes option pricing more expensive. The spread is further apart from each other, so the strikes are further from each other, making them harder to value. You know, if a 1% move used to give you, for example, today will give you a 200 or 300% return. Now it's probably really hard to even get 100% return. So it's very important to always keep an eye on the VIX and make sure that you get it whenever you're buying the options. You could get it sometime when it's under 20. Why under 20 or under 15? Because there's still high enough volatility where the contracts are going to value or gain in value, and they're not far, and they're still valuable. Does that make sense? I'm trying to put everything together in a way that it's most comprehensive as possible. But yeah, we're just gonna sit back today, watch the market, wait for whatever situation is going on right now to get settled, and hopefully next week is a better week. Wish you guys a happy Friday, happy weekend. I'll see you Monday.